This podcast is made possible by Planful.
Hi, this is Elaine Sun, COO and CFO of Mammoth Biosciences, and you are listening to the CFO Thought Leader Podcast.
This is episode 827.
A year ago, Zillow estimated that the U.S. homeowner property value was $43 trillion. Recently, a Bankrate survey told us that 63% of Americans' wealth is in their homes. Yet, Experian also provided us with the insight that 56% of Americans can't handle a $1,000 unexpected bill, and 25% of Americans have a FICO score below 630. So what we do is help customers access the equity in their home and improve their financial footprint. We've been around since 2016. We are a later stage startup. We've raised Series C capital last year and are looking to do our Series D raise at this time.
Hi, it's Jack. On today's show, we speak with CFO Debbie Schleicher of EasyKnock. When Debbie Schleicher tells us that a football game between Georgia Tech and Clemson became her door opener to the CFO office, we can't help but want to listen. Back in 2014, Schleicher and her family were invited by a former client and serial CEO to one of the most anticipated games of the season. Unfortunately, Georgia Tech beat Clemson 28-6. Remember Schleicher, whose husband is a proud Clemson alum? Nevertheless, Schleicher left the game with a job offer in hand. That story and much more on today's episode. We begin after this. In an ever-changing world, it can be tough to keep up with the latest FP&A trends and innovations that keep you ahead of the game. Luckily, there's a podcast for that. Tune in to Being Planful, the podcast for finance leaders and planning experts, and stay in the know about what's happening in planning and forecasting. Guests like influencer Chris Ortega, Boston Red Sox CFO Tim Zhu, and Brian Lapidus of AFP will keep you up to speed on how you can put finance in the driver's seat this year. Find the full episodes at beingplanful.com or wherever you get your podcasts. P.S. Think you might make a great guest on the show? Shoot host Rowan Tonkin an email at beingplanful@planful.com. Hello, we're speaking with Debbie Schleicher, CFO of EasyKnock. Debbie, welcome.
Thank you, Jack.
So Debbie, we always begin by asking our guests to look back for us and identify experiences they feel prepared them for a CFO role. What would come to mind for you?
Well, Jack, I enjoy theater. And when I think about my career, I can really think about it in two acts. And so I would call the first act the act of public accounting. My first job after graduating from the University of Delaware was with Arthur Andersen in the Baltimore office. And I was an audit staff. I'm somebody who really likes experiences and challenges, and I can get bored pretty quickly doing the same thing for a long time. So somewhere around my manager years, I transferred from the audit division into the tax division. And I made partner there in the 90s. So I guess that's really dating myself, but it was the late 90s. My last public accounting role was at Grant Thornton. And at Grant Thornton, I was a partner, and I started technology-enabled practices, two of them, one around tax provisioning and one around outsourcing service lines. And, just like many shows in the theater, Act One can be kind of long. And for me, the first act was really long. It was 28 years. So I will often, to this day, get a question, of how did a tax partner who was in public accounting and, who probably was considered a lifer, somebody who would stay until retirement, how did I find myself as the CFO of a high growth tech enabled company?
You're reading our minds. You have to answer this question. But you know what? I want to wait. I want to find that out. But right now, I want to ask you something about your first act, which, as you explained so nicely for us, really was about Andersen, where you spent something like 15 years and became a partner, and you were there when it collapsed. And I'm not sure every of all of our listeners can appreciate what exactly happened there. It happened as part of the Enron era, the accounting house that had been a powerhouse for most of the last century disappeared within a short amount of time, just disappeared. But when I do speak to finance leaders who grew up in that environment, who grew their careers in that environment, they loved it. There was such a sense of loyalty to it. And I want to ask you about that. What was it? What was it exactly about Andersen?
Yeah, sure. I mean, you just hit something I care deeply about. Arthur Andersen was my first job, and it had a very strong culture. I truly loved it, and I'm sure I would still be there today if I was still working. But I would still be there today if it hadn't collapsed.
Was that the mentorship? When you say strong culture, and you told us something that's really interesting, you'd still be there. You loved it.
Yeah, I did.
Was it because you had people who developed you, who are concerned about you? What is it that made that so special when you think back? Because we hear that all the time. It was a wonderful culture. But and as someone who has talked to a lot of Arthur Andersen people, I'm always like, well, what was it?
Well, very much so. When you say, was it because of people who developed me? I mean, there were a lot of neat things about Arthur Andersen. One of them was this idea of stewardship, and that you leave behind a better firm than the one you joined, and that you help others succeed. And, as you were asking me the question, I mean, the very first thing that popped into mind is somebody who was a mentor, not just to me. If, people listening to this podcast who know me and know him, Mike Baldessaro was very well loved. So, and you also said, were there a lot of women partners? No, at the time there weren't. And I had been given an opportunity. I think I was a senior manager at the time to join a specialty team, and I might get the numbers wrong, but it was a large group. Maybe it was 80 people. And one thing that just struck me is the first meeting I ever went to, I think there were 2 or 3 women out of maybe 80 people. So it's a different time today, fortunately, more diversity. But I was real new to this team, and it was a team that did corporate transactions and mergers and acquisitions. So some pretty interesting, tricky stuff. I was in the Baltimore office and had a good client opportunity. Mike Baldessaro led the team. So, he was one of these partners who, as a senior manager, I really held in high regard, and somehow he got involved and was going to come down and go to this client meeting with me, because as a brand new senior manager, brand new to the team, I probably wasn't ready. Well, Mike did come down, but instead of coming down to lead the meeting, he called me a couple days before and he said, okay, we're going to go through the entire presentation and you're going to do this. And I said, but Mike, I haven't done anything like this before. And he goes, well, you're going to, and you're going to know everything about it in a couple of days. And so he taught me everything I needed to know to be successful in that meeting.
Help us understand who Mike is better for those who might not be aware. He must have been was he the managing, was he very senior? Help us understand.
He was a partner in New York, very senior partner in tax, and led some specialty teams.
And he just saw this probably as the ultimate window where he could really help you step up. He was, I mean, it was stressful, I'm sure, but what he was doing is he understood you could do it. He just needed the mentoring time with you for you to step up and have the confidence to do it. Or do you see it differently?
Nope, that's right.
Okay. What about the end chapter there? Anything you can share with us as you, and again, you're in the tax practice, a world away from all of what happened, I would think, and from what I recall, didn't leave a bitter taste in your mouth about accounting or the circumstances, or nothing to share with us on that?
there are a lot of lessons there. It's, the old, what doesn't kill you makes you stronger. I mean, up until that point, I really hadn't had anything that was terribly adverse occur in my life, personal or in my career. And so I think that the experience really was a way that I gained confidence. I understood that things can go wrong and things can be rocky, and that you just get up and brush yourself off and you keep on going, and that's okay. And there will be disappointments, and that's okay.
We mentioned Grant Thornton as well being another chapter for you. You became national partner in charge of tax and finance optimization. Big role. I mean, did you step into that role? Did they say, yes, you're the one?
Well, one of the reasons I came to the firm was I had developed that specialty niche already. I had been working in a well-respected local regional firm, SC&H, and had started working in that area, and it was something Grant Thornton was looking to get into. So bringing me on was part of that plan for Grant Thornton at the time.
Yeah. Okay. And as you were explaining then, you never, at this time, you're still thinking of yourself as a tax expert. Am I right about that? In the finance world, you're the tax person. You're the, you're the tax expert. And you go through this evolution where you serve in a number of CFO roles and more like startups, very entrepreneurial in some ways, or certainly entrepreneurial. Yes. So how does this happen? What's the itch that you get?
Well, it's really actually a kind of a fun story, how it all came to be. It was November 14th, 2014. And I remember the date, not because I have a perfect memory for dates, but because I was able to look it up. It was a day where there was a series of unexpected events that occurred. And, there's that kid's book. I don't know if you're familiar with it, A Series of Unfortunate Events. It's one of my son's favorites. And there were three events that were noteworthy. One of them was unfortunate, and two turned out to be pretty great. The unfortunate one, we had been invited by the ex-CEO of one of my ex-clients to see the Georgia Tech Clemson football game, which is why I know the date and I could look it up. And my daughter was looking at Georgia Tech as a school. She was college bound in the future. Unfortunately, Georgia Tech beat Clemson 28-6. And this was my husband's alma mater. We're huge diehard Clemson fans. So for us, this was, of the unexpected events, the one that was unfortunate. The other two that occurred, the next thing was unexpected in that my daughter didn't end up going to Georgia Tech, but my son later did, and he became a Yellow Jacket, which was great. But it's the third unexpected event that led to my first CFO role. So during that game, that ex-CEO, his name's Greg asked me if I might want to join Iron Planet as his CFO. And I knew Greg's track record for success, and it was pretty great. So I was really excited to be having this conversation. He asked me if I'd be interested in the role. And I remember really clearly, I was very surprised, and I took a really long pause and didn't say anything because I was thinking, am I ready to be CFO? I mean, I was a tax partner, as you said, a tax expert. That was my thing. And he looked at me and he said, is there anything in this role that you don't think that you can do? And, I confidently and somewhat immediately responded. And I said, no, I can do anything. I can do the role. And the reason why I thought I was ready is I knew I had the technical ability. I had a really good track record of building teams, and I knew that would be important. And I had built service lines in the past from the ground up. So I felt like I knew how to help build a company.
So what transpires? Are you on board shortly thereafter, or what happens exactly?
Well, you said you wanted to know a bit about some of my experiences that kind of got me there. While Greg wanted to talk to me about the role, I had a lot of explaining to do about my background just to make sure that this seemed like it could make some sense. So I did share a few experiences with him. I mentioned before that I had been with SC&H, a regional firm. What I didn't say is that when I started, I was one of the people that was brought in to help them build their DC income tax practice from scratch. And so, I mean, I will never forget the moment I walked into empty hoteling space in Tyson's Corner, and I walked into a room and there was a desk and a phone, and that was it. And I realized that I had no clients, no staff, and if I needed to make something happen. So I picked up the phone that was sitting on the desk, and I called my somebody I had worked with before. Her name's Wendy. Hopefully she's listening to this. Wendy was the perfect first team member. I mean, I had some relationships where we were fortunate enough to get some projects right away, but Wendy was really smart, and I trusted her completely, and so did our clients. And so one project turned into another. We used our network, found the next key employees, and person after person, we built a team. I remember Teresa joined, and we grew the practice so big that Teresa was able to make partner, which, I mean, that's just, when you've been in public accounting a long time, the ability to help somebody else progress to partner is just such a rewarding experience for everybody involved. And I knew that if I were to be the CFO at Iron Planet, my success would really be dependent on if I could build a strong team there. So, and I could probably spend the rest of the podcast talking about that team, how we came together, who they were. To this day, it's one of the most special groups of people I've worked with. The trust on that team was really solid, and we would have done anything for each other, and we still do. We still would today.
So this is really you offering some details about your background and what came to mind for you as you had this conversation. And what else? What else did you share? I mean, this is you outlining some past experiences to the CEO of Iron Planet.
Yes. So I'm at this point, we're talking about when I was, in a way, informally at a football game, interviewing for the job, explaining things I had done in the past that would kind of help me, help see if I was a good fit for a CFO role. And there was another really key experience that we talked about. I had built a business partnership with a promising startup company, which was called TaxStream at the time. And it was a really interesting opportunity for me because even though I was in firms, this was a startup that was developing a tax provisioning software product. And I think I was their first implementation partner. I worked with them as a tax subject matter expert. I did implementations with them. And as they grew, I even helped them formulate what their implementation channel partner program was going to be all about. And working with them through their growth cycle and their eventual exit, they were purchased by Thomson Reuters and one of the most successful tax provisioning products out there. It really helped me learn how to navigate growth. And I'm just grateful to them for the impact they had on my own career. So at this point, Greg was pretty satisfied with what I had explained, but he had a really important question for me. And he stopped me and he said, Debbie, he goes, I really need to know something. He said, can you make decisions? And he knew that I could understand the issues, but what he was really getting at is, would I know how much information I needed? Would I be able to make quick decisions and even hard decisions and make them fast enough to keep the business moving forward? And that was really a big aha moment for me. I don't think in any of my time in public accounting, the thought of being capable and having a good decision-making framework, that hadn't been something that was emphasized as a partner in public accounting. And I realized, there were going to be problems to solve, and I was going to need to make the decisions to move things to go forward. And I still think about that conversation today whenever I'm faced with a question about, should I approve a spend where the ROI looks uncertain, or should we make a pricing change? And what will that do? And I kind of think back to the need for speed sometimes when it's appropriate to make a decision.
thank you for giving us a nice overview. We might have, or I should say, I know we'll have a few more career-related questions for you a little later in the podcast. But right now, let's find out about EasyKnock. What does this company do, and what are its offerings today?
Sure. So maybe I'll start just by sharing a little bit about our founder and his mission. So Jared Kessler founded EasyKnock with a mission to help homeowners access the equity in their homes and provide options that traditional channels don't. And, Jared's really passionate about why he formed the company. And it's fun to be part of a mission-driven organization because all of us are bought in and all of us are very excited about what we're trying to do. We help customers get money that they need when they need it to do things like home renovations, fund education, maybe even to have money to make a move. And I will tell you a bit about the product in a minute. But it's a CFO podcast, so I kind of feel like I have to share some numbers to give some context to how big the company is and what we're doing and what our market space is. A year ago, Zillow estimated that the U.S. homeowner property value was $43 trillion. Recently, a Bankrate survey told us that 63% of Americans' wealth is in their homes. Yet Experian also provided us with the insight that 56% of Americans can't handle a $1,000 unexpected bill, and 25% of Americans have a FICO score below 630. So what we do is help customers access the equity in their home and improve their financial footprint. Our customers can even see FICO score improvement when they're with EasyKnock as tenants. We've been around since 2016. We are a later stage startup. We've raised Series C capital last year and are looking to do our Series D raise at this time. We've helped almost 1,700 customers, and we have 1,200 homes in our portfolio today. And we're really proud that we've been recognized by Inc. as a best places to work and fastest growing company. So you're listening to all of this and you're like, pretty cool, but what do they do, right? What do they do? So let me tell you a bit about our product. We have a sale leaseback solution for homeowners. In general, we buy their house and we lease it back to them. And the seller of the home now becomes our tenant. Sell and Stay is one of our products. With Sell and Stay, the homeowner pays us rent and fees. Our revenue streams are rent and fees, and they can remain in the home as a tenant as long as they choose to renew their lease and as long as they remain in good standing. We give them options, literally options. They get something that we call option value. And while they're renting, they always at any point in time have the option to ask us to sell the home. And if we do, they receive the proceeds from that home, less amounts owed to us, which can give them the economic benefit of home ownership because they can participate in the appreciation. They can get the appreciation in the home. Or they can buy the house back from us at a price that was predetermined on the day we purchased it from them. About 30% of our homeowners, the dispositions have resulted in the customer purchasing the home back.
Can you give us a sense of when you first heard about it? Were you aware of other types of offerings out there, or what? Give us a sense of how unusual this type of transaction is and the types of companies that are out there offering it.
Yeah, sure. Some of our biggest competition is actually that somebody would sell their home, as opposed to come to EasyKnock to sell it to us and lease it back. They would just sell their home. In that case, though, that individual would have to leave their home, and that isn't what they always want. So there are other companies, but the other companies have more limited offerings. So you've got iBuyers, companies like Open Door and OfferPad, and they'll purchase the home, but that doesn't permit continued occupancy either. There are companies where somebody is moving and they help you make a non-contingent offer on a new home. But what that solution doesn't do is solve the problem for a homeowner that needs to sell their home because they can't carry two mortgages. With our movability product, that's another one of our products, somebody can stay in the home for up to a year, and we've purchased the home already, so they don't have two mortgages to address when they're looking to buy another home. And then, there are the fractional ownership solutions where somebody can receive cash for their equity in their home, but they lose that potential of having continued upside in the property should they stay in the home and the property appreciates. So we really do think that what we're doing is pretty unique.
Could you give us sort of a hypothetical of the circumstances or the customer? It seems to me there's a homeowner is in having financial difficulties of one form or another, and this option becomes attractive given the lack of liquidity.
It could be. So, we have the sell and stay product and the movability product. For the movability product, actually, we get a lot of referrals from realtors. It's really somebody who's looking to move and needs cash for part of that process. It could be for part of the down payment to fix up their home in advance. So it may have nothing to do with a financial difficulty or concern. We could have customers who at one point, qualified for a mortgage, built up considerable equity in their home, but life happens, and maybe right now they don't have a steady income or not a W-2 employee, or for some reason it's not easy for them to get a home equity loan as an option. So but they don't want to leave their home, so we become an option for that. But really it could just be anybody who wants to stay in their home and who wants to find a way to tap into the equity and have that option of stepping back into the shoes of being a homeowner if they choose to.
When you step into the role, do you have all the visibility you need? Are the numbers available to you? Did you have to upgrade some of the technology? I know you've been there roughly a year, I suppose, but what steps did you take to increase your lines of sight and make certain you understood, how the company was performing?
Yes. I mean, I've been with EasyKnock 11 months. And you asked a few questions in there. Maybe I'll think about or speak about what I saw and what I'm doing with the big elements of how to run a finance function and how a company is run. And that's, people, human capital, the processes and the technology, and frankly, the data that we have access to that we use to run the company. With respect to, I'll start kind of small and myopic with respect to my accounting and finance team. Our company's growing fast, and we definitely needed to add some resource there. We hadn't yet had our first independent financial statement audit. Baker Tilly is doing that right now. And so we had some work to do to prepare for that initially. We also had not separated our accounting team and our finance team into PropCo, OpCo, which after spending a few months and learning about what the needs of the company were, it seemed important. What we do, we have a big portfolio of homes, and managing property companies, the financing that we need for the companies, the property management, recording the transactions. We buy a house, we sell a house. There's a lot of real estate transactions. That is, it's very transactional. It's very unique compared to what I might call normal corporate accounting, financing, and oversight function. And so I've now separated those teams, and that's making a big difference. It's allowing more focus. It's allowing a platform for internal controls, because we can have a corporate team that does consolidation, account reconciliations, oversight and review, segregation of duties. So there was a change to be made there. As it relates to systems, when I joined, the company was moving on to NetSuite. So one of the priorities was to complete a NetSuite implementation. And we got on a new AP system as well, because we needed to have a fundamental finance system that could support more integration with the other tools in the company that we use. We have a really big focus right now on finding efficiency and being able to scale without adding a lot of people, because we have to minimize the manual processes. I talked about, we have a lot of transactions to account for. And that's just on the accounting side. We have a lot of operational transactions to manage. And many people in different departments need access to data. We need the same data. So company-wide, this isn't something that I'm leading. Company-wide, we have a cross-departmental significant effort to digitize and automate all of the pieces of data and all of the documents that touch our transaction, with the end goal of getting them all into NetSuite without much touch, so that we can do complete and accurate financial reporting.
Is there Is there a timeline or a time frame for what you're trying to accomplish?
It's a journey. Yeah, it's a journey. Like what I'm describing, as I'm sure anyone listening can realize, is a multi-year effort, and it never ends, right? Because you finish something and you tackle the next. I'd say over the next 4 quarters, we have significant plans in that regard. I'm sure beyond that as well.
Are you able to understand whether a certain transaction is correctly on course? With so many customers, and part of the conversation we've been having with other finance leaders is how they're able to see whether a customer is on track to grow with them, to grow over time. Here it's transactional. So are you able to see whether a transaction's on track and whether it's maturing the way it should? I don't know, but I'm curious to see if you're enjoying that type of visibility, um, and whether you expect to.
Yes, we have great visibility into our customers and what they're doing, and frankly, how long they stay with us. Their tenancy is important to us. You asked about counting the number of transactions. In a way, it's a byproduct. Our North Star is revenue growth. And if you back up from revenue growth, what drives it? So we make our money with rent. Our customers pay market rents, and we take fees for what we do. And so we in order to make revenue, we would be looking at our portfolio size, because rent continues for as long as somebody is a tenant. So a customer that we acquire that ends up leasing the home back from us for 4 years, we're going to have 4 years worth of rent from that customer acquisition. And somebody who's with us only a year, it will just be 1 year. Some of the fee income is more transactional. So it happens at the beginning or the end of the relationship. So for us, really what we care about is just understanding and being able to have some prediction, because it affects cash flows and how we forecast and plan the business. We want to understand what percent of our customers are expected to have a 1 year, 2 year, 3 year, 4 year tenancy. That's very important. And we have a great data team and we use Tableau, so we have good reporting. And so, yes, we do have visibility into that. And there's 2 components to growing our portfolio. There's new customers that come on board, and then, to kind of steal a term from SaaS, there's churn. I mean, for us, churn means somebody has exercised that option. They've decided they no longer want to remain in the home, and so they either want to buy it back from us, or they ask us to go sell our house and provide them with the proceeds that they're entitled
That's great.
to.
That's very helpful. When we look at your workforce, I would think the finance folks might not necessarily have a real estate background, where I wouldn't be surprised that many of your salespeople or some of the other roles, yes, in fact, part of the workforce do have a background in real estate, or their careers have been part of the real estate world in the past. Do you know what I'm asking? So the finance folks didn't necessarily have that background, but much of the workforce does. No?
Well, I didn't have that background, if that's what you were alluding to.
Well, the same thing. If you were to make an accounting hire, you would be looking for a good accountant. Or if you were looking for an FP&A hire, you might think, well, they can certainly understand the business after given all of their planning and financial analysis background. No, that's not the case.
Well, no, look, we have people in the organization that do have real estate backgrounds. This is SFR, and so in particular, I mean, that's helpful. We have people that came out of lending organizations that dealt with SFR, so yes, they have the industry knowledge. As it relates to my hire, I'm a piece of a puzzle, and I mentioned before I've split my team into PropCo, OpCo. My OpCo team, the corporate team that I've hired, these are great CPAs who know how to be controllers and assistant controllers and get the books closed. But the property team has significant experience in in our business. Some of them have been with the company since the beginning. And I have a CFO of the PropCos, a guy named Ron Wexler, who is intimately involved in our transactions. He approves deals. He's aware of. He really is probably the key person that helps figure out what our pricing should be, and he manages our FP&A financial model. So we really do have that talent on the accounting and finance team.
Interesting. Can you give us a sense of your, just touching on talent a little more, your talent mindset, whether you're hiring this year, whether you're not hiring this year, whether it's presenting certain challenges to you, the hiring environment?
Yeah, it's a good question. We have hired this year. We started the year off really in a very high growth mode, planning to be a bigger organization. And we haven't stopped hiring. We've hired some key roles, including new executive roles over the last couple of months. And definitely, as far as the sales force goes, we are continuing to hire. Our company, we believe that we're somewhat counter-cyclical. I mean, I think the reason you're asking this question is we're finding ourselves in a really challenging economy right now. We have rising interest rates, and yes, that impacts us because it addresses our cost of capital for home acquisitions. However, the demand for our product, we see that the demand for our product is very strong because we are giving people options when they need it. The challenge is we have a lot of demand, and we are, operating in the same economy everybody else is with inflation and higher interest rates. So there is that. And I've said before, we're a growing late stage startup company. So we still do need to manage cash and be careful and cautious, which we are. Yes, the short answer is yes, we're still hiring, perhaps with a little more caution than a month ago, but we have important positions to fill and we're growing. So we need to manage for that.
Excellent. We're going to jump to our finance strategic moment question. And this is where we're looking for a moment of strategic and insight that you've experienced during the course of your career. It could have happened back at Arthur Andersen. It might have happened 6 months ago. But we're looking for a moment of strategic insight that you've had because of your unique lines of sight into the organization that you responded to, whether it was a risk that you avoided, an opportunity that you pursued. Anything come to mind when we ask for a finance strategic moment?
Well, yes. When I started the podcast, I did speak about being in public accounting for such a long time. And for over 20 years, I lived and breathed tax. I was a tax partner. And when I think about tax, there's so many different tax types, and I'm not sure why, but I always think about, the Forrest Gump movie, and there's Bubba who goes on and on about shrimp. He goes, there's pineapple shrimp, and then there's lemon shrimp and coconut shrimp and shrimp soup, shrimp stew. And, he goes on. And I kind of feel that way about tax sometimes. There's income tax, state and local tax, sales and use tax, VAT. And the reason, I kind of am listing out tax types is after being, a tax partner, one thing that I had to learn was that in the startup company world, taxes are not necessarily the very first thing that's keeping a founder up at night. I mean, look, there are some important things to do, and whenever I get a chance to make a plug, I like to remind young companies, startup companies, that compliance is important because it'll end up hurting value later down the road. Things like, are you compliant with sales and use tax? It's just better to be compliant than not. But that isn't really my point or where I'm going with this. With respect to income tax, very young startup doesn't pay income tax. They're generating NOL, so it isn't top of mind. And then you kind of move on to a little bit further down the chain, and you're starting to look at valuations based on revenue growth. Again, not income tax. You still might not be paying income tax. So not top of mind when you're thinking about valuation and an exit. And then last, then comes EBITDA, right? Now you're profitable and your value is based on EBITDA multiples. And what's EBITDA? Well, taxes aren't considered. And so income tax doesn't always get early enough in the consideration, enough resource. It's often outsourced. And with outsourcing, you really run the risk of not having deep financial planning and strategy involved. So the moment that I want to share, the story that I want to share is that I think because of my own focus on tax, I was really able to add a lot of value to a company's exit transaction. We were working on an M&A transaction, a sell side transaction, and the company that was being sold and the company that was the acquirer just weren't getting there on a price that everyone was comfortable with. The sell side company really thought that they had great growth ahead of them, and so wanted some of that future growth priced into the transaction value. And the company that was doing the acquisition did try, but just couldn't get there. And then everyone spent some time looking really hard at synergies, because if you can find good synergy, both sides wanted the transaction to happen. But if you could find great synergies, you could find more value and perhaps support a higher purchase price. And then it dawned on me that the company had really large deferred tax assets. Deferred tax assets are assets that are going to produce tax savings or tax deductions in the future. And that the actual transaction itself, the way would trigger additional deferred tax assets to arise. And so just by doing the transaction, there was this very valuable asset being created that would benefit the acquiring company. And when I brought that to the negotiation table, it was one of the pieces that got the deal done. And so in a way, I found a way to pay for the higher price for the company. And I like to think that strategic financial insight really made a difference in that transaction and had a major role in a successful exit.
Hi, it's Jack. I hope you're enjoying our conversation with CFO Debbie Schleicher. So we probably saw that one coming. A finance strategic moment from, without a doubt, a tax expert and CFO. We'll now return to our conversation. We're going to jump to our mentoring round, where we're going to ask you about your first 30 or 60 days in a CFO role. If you could go back in time, and maybe it was that Iron Planet, if you could go back in time and just give yourself a piece of advice, what would it be? Again, it was the first time you were a CFO. It's only been 30 days, something you can go back and tell yourself, hey, don't forget this or remember this. What would it be?
Yeah, it would be to understand the importance of trust. When I even got that first Iron Planet CFO role, I remember that the board was asking Greg, the CEO, why a first-time CFO? We're looking to move to IPO readiness. We're at a really critical stage, and you're saying you want to hire a first-time CFO. And his answer, and they said, but we trust you, and so we will let you make the decision. And he said to me, the reason I want to do this is I trust you. We've worked together before, and I know you'll do the right thing. And that's why I think you're the right person for the job. And, I've always taken trust a little bit too much for granted, because I think that it needs a really important role. And when you think about building teams, it needs a lot of work. Warren Buffett has been quoted to say, trust is like the air that we breathe. Nobody really notices when it's present, but everybody really notices when it's absent. And, that's right, because when you could perfectly curate a team, you can have the right skills. And if they aren't comfortable arguing and speaking with each other openly and honestly, and they feel like they have to watch their backs, they're not going to bring their best selves to work, and they're not going to operate well as a team. And so that's really what I would tell my younger self, which is to don't take trust for granted. It's so important, and you have to be strategic, and you have to work on it.
Great advice for us. It's interesting. We do touch on trust in this podcast in all different areas, but I don't think we've touched on it with this question. So thank you for that. We're going to ask you, this is where we ask guests to reflect a little on the personal side for us. We're wondering if you have a personal habit or part of a daily routine that you're known for. This is something other people, maybe a family member actually, would point out to us and say, yep, that's what she does. Anything come to mind when we ask for a personal habit or daily routine that you have?
Well, I don't know about a family member because I actually probably should do this more at home and we'd be more organized. It's definitely my husband who takes care of keeping things in the house on track. A personal habit, I don't think it's all that different from what many people do. But at the end of every day, I compartmentalize timeframes. I think about what do I have to do tomorrow? What's most important to do tomorrow? Not just for me, but for the people that I'm working closely with. What about this week? What about this month? And what about this quarter? And I really try to force myself to have that thought process every day. And I work in a very rapidly changing environment. I mean, never more so than today. We have to respond to what's going on in the macro economy. And so our priorities one day might not still be the same priority the next day. And it's really important when we're still a small enough team that we can talk, we can be in close communication. It's really important that we stay in sync and we stay aligned, especially when what we thought was most important yesterday might not be the next day.
We also like to ask if you have a book recommendation for us.
I do. You know, we just came off of our EasyKnock all employee, all hands meeting. And we read a book which is called The 5 Dysfunctions of Team. And apparently it's not a brand new book. A lot of people have read it. So anybody listening who's read it knows that it's written in a really wonderful way to read. It tells a story. There are characters of an executive team that is not functioning well as a team. And I will tell you that I could relate to those characters. I could relate to the CFO character, but I saw a lot of the good habits that I have seen when teams are working well together. And I saw a lot of the bad habits, and it really puts it into perspective. I won't go through all of the habits, but interestingly enough, it resonated with me because the first dysfunction was lack of trust. And that you really, if you don't have that, you can't even build on the other elements that you need to be a successful team. You just kind of get stuck right there.
All right, we'll put it. The Patrick Lancioni, I believe, is the author.
Yes, you got it.
And
yeah.
So a popular choice, but you linked it to your trust advice, which is kind of nice. And actually, you've intrigued us about how the author writes about characteristics. That's interesting. We hadn't had that shared before. This is where we ask you for your priorities as a finance leader for the next 12 months. What would those priorities be?
Well, I think the number one priority is to make sure that we have the right capital to fund our business. As a growing company, it's important that we have capital to fund growth. But given what we do, we also need cost-effective capital to fund our home acquisitions. And interest rates are very high right now relative to where they were, even at the beginning of this year. And so getting an efficient cost of capital, addressing new markets, setting ourselves up for securitization could be an example of something that would make a big difference for us and a more efficient cost of capital. That is our number one priority. Second to that would be to do my own part within our management team to lower costs and give us the speed to transact by making sure that we're successful with this project that I mentioned before, where we're moving to even more digitization of our records that we have today, building automation off of it, and having our systems all talk to each other.
Debbie Schleicher, thank you for joining us on CFO Thought Leader.
You're welcome. It was fun. Thank you.
Hello, listeners. Do us a favor. Be certain to subscribe to CFO Thought Leader on Apple Podcasts, or if you're an Android user, check us out on Spotify or Google Play. If you like the show, please recommend it to a friend.